Welcome to Faster Please, the podcast, the audiovisual companion of my Faster Please newsletter. I'm your host, Jim Pethokoukis. My guest today is Azeem Azhar. Azeem is a longtime angel investor in tech, and he's the founder of Exponential View, a research platform focused on helping leaders understand emerging technologies and their impact on society. He's a digital fellow at the great Stanford Digital Economy Lab, executive fellow over at Harvard Business, and the author of the Exponential Age book. He also recently co-authored The State of the AI Economy. It's really one of the first serious attempts to measure the size and trajectory of the AI economy from the demand side, what customers are actually paying for. Azeem, no surprise, we're going to talk about where the AI economy stands, where it might be headed. Great to chat with you again. I first wanted to get a sense of I think you're an AI optimist, correct? Do I got that right?
Am I an optimist? I'm going to use your terms, Jim. I'm probably more on the seller line than I am on the sort of San Francisco consensus start of the world.
Great. Right. Well, good, though. That's perfect, because I have a quote here from Demis Hassabis of Google DeepMind. He recently posted this on Twitter, and I wanted you to think about it and then answer. Hassabis said, "This is a pivotal moment in human history. Artificial general intelligence is probably only a few short years away. The magnitude of the technology's impact will be unprecedented, perhaps 10 times that of the Industrial Revolution. We could reach a point where resources are no longer the limiting factor for human progress, leading to an amazing new era of abundance." What do you make of that sort of thinking? And is that the kind of thing that would factor into your sort of broad investment thesis?
I always wonder how something like that will play out in Peoria or Atlanta or in Milton Keynes in the UK, in the places where ordinary people live. I think what Demis said has been true for nearly 200 years in the Western world. The moment that we started to have sustained economic growth, starting in the 18th century, that world looks like a world of abundance compared to any of the humans who lived in the 300,000 years before then. And what did we learn about the modern economy, industrial capitalism, is that it may look like abundance when you're on the other side, before the inflection, but when you're in it, it really looks like a day-to-day grind where you still have to fight for the things that you care about. There are still temporary shortages. There are certain types of scarcities that have disappeared. People don't die of smallpox anymore. So there is a scarcity of people dying of smallpox. So we have made progress. But the notion of abundance in general, I think, defies the realities of physics. You always need energy to get something done, of time. You can't, you and I can't both eat the same banana, Jim. I mean, if we started at opposite ends, I promise you I'd eat more than half of it. But these are still real, tangible things. So I'm always a bit skeptical about that. But I also agree that what AI could do is find a way of taking us to a new level of growth above this last 300 years historical average of 1.6 to 2% per year.
So I think the sort of, again, the realist looking at like where we are today, that certainly infuses really this great report that you put out called The State of the AI Economy. And this is a very incomplete way of describing it, but these are the two headline numbers that you use, so I'm going to use them too, where you say the generative AI economy has generated about $110 billion in sales over the last year, and on an annualized basis, the revenue run rate exceeds $175 billion. And to be clear, these are not right. These are numbers about companies and consumers buying AI capabilities, applications. These are from the model makers, the cloud providers. We're not talking about the chip makers or anything like that. One way I interpret those two numbers, those revenue numbers, from the perspective of someone who lived through the 1990s internet boom. So we're talking about actual money that actual customers are handing over. This is not about valuations or companies buying from each other. We're talking about real people and businesses. I think people and businesses are paying for stuff If you're a bubble worrier, like this is good news because like real stuff is being paid for, real money is being handed over.
Yeah, real money is being handed over. It's about 3 times faster than the internet boom or mobile apps. There is some venture capital in there that is being spent. So we know that the average venture-backed company in America spends, I think the number that Ramp, which is a fintech that tracks this stuff, spends about $11 per employee per month. There are about 4 million people employed by venture-backed companies. So arguably 4 billion of that 110 billion is Series A, Series B seed funding on pre-profitable companies. And then you also do have the fact that the big frontier labs like OpenAI and Anthropic are spending significantly on infrastructure from people like Amazon and Google to train their next models. But we figured that out to be about in the 15 to $20 billion mark over the last 12 months. So even if you take a very, very hard line and say, we're going to change the rules of American capitalism and the American economy for this particular sector and say risk capital no longer counts as real revenue, you're still at a number that's around $85, $90 billion, which is still the fastest growing sector we have ever seen. So yes, I mean, I think that this is real money, but I would say that doesn't mean we're out of the woods. You know, this is an early shoot.
Let me jump in then and say, because two things. I want to first, you mentioned, okay, I want to get to the out of the woods, but just quickly, a lot of times we're grasping for historical analogies, and you mentioned that this is happening much faster than prior IT waves. So when I hear that data point, it sort of informs this question, which is the reason this thing is scaling and that this money is being spent, is this reflecting companies buying these tools because they're finding, because they started to buy them, they're finding them useful, so they're buying more of the services? Is it that because they're putting these things to productive use, or is this still really, hey, what's this all about? We better, we don't want to miss out. We at least better try to make use of them. Like, where are we?
I think we've got past the stage, certainly in the US, where this is about random experimentation and giving everyone a co-pilot. Companies are starting to get much more sensible and strategic, and they're learning about how to deliver this. What we don't have yet is binders full, to use a Mitt Romney phrase, binders full of of huge ROI successes from every sector. And I'm not sure when history would tell us we would get those binders. But what we normally know with technology is that there's a J curve of investment. You invest up front and then you start to see the returns. I think one of the things that's really difficult to tell right now is that a company that is being really successful with generative AI will be running in the red very heavily now, because they will have been successful with a pilot and they will run a dozen or more new projects in parallel, all of which they are investing in. And a company that has no clue about what it's doing and is really poorly run and is just throwing money into the fire will have exactly the same sea of red in the same number. So you can't really tell from that data one from the other. What we have to just have some faith in is what happens when we talk to CEOs and what they tell us, and do they sound like they are men and women driving off a cliff at high speed, or do they sound like people who are really trying to fix the car on the road and realize it's got potential? And in general, they sound like the latter.
I recently did a chat with Eric Brynjolfsson, who to me sounded long run and even medium run optimistic, but a little disappointed that there are not those binders full of high return applications. Are you disappointed at sort of the pace that we're seeing of the productive use of this technologies that ends up transferring down to the bottom line, and we see big profit gains and eventually big productivity gains?
You know what? I'm more disappointed in how I disrespected history 2 or 3 years ago, because what we're actually learning is that companies are going through the similar type of process that Paul David describes around electrification, which is that you can put the light bulbs in the workshop. That is the co-pilot, but to move to the moving assembly line requires a lot more work and a lot more expertise. And that's what I see when I talk to company bosses, both in the US and in Europe. They can point to a handful of growing examples which look like they are AI native, and a large set of examples which is just hanging light bulbs, in your existing systems. So the disappointment, I think, for me is just that I should have had much more sense to look at what the economists and the academics had done when they'd studied general purpose technologies previously. I am constantly surprised by the sophistication of apps that I see, even large, slow-moving companies. I spent some time with a government contractor in McLean in Virginia, or is it McLean up in Virginia? And they're quite a stodgy business, and they really had some impressive apps. What it brought back to me was there's a depth of expertise that is building, but it is still really difficult to transform a firm. It's very easy for a management consultant to say. It's really hard to do it in real life. And the thing that would keep the optimist going is that what I hear are companies who are ready to persist with learning how to do that, and feel that they are, even if it's gone slower in 26 than they thought it might have done 2 years ago.
Is what we're seeing companies, I think these are two different things, being more efficient at what they do versus them doing like new things to create new sources of revenue. I assume those are two very different things, and assuming those are two very different things, are we seeing much of either?
Well, I mean, it's definitely the focus is on the cost efficiencies in the first instance, and there's simple both kind of managerial and financial reasons for it. Financial reason is that you effectively do better with a cost efficiency because you don't have to worry about the margin that your new product or service has to achieve. And managerially, it's easy because you already know exactly how that process works and what good looks like and what the interfaces are between each process. And that's where companies started, and some went too fast. I think we know the story of some of the early fintechs or a couple of car companies who've been trying to hire execs back. In terms of genuinely new and novel products,
Which I would assume, are those going to come from the existing companies, or we're talking like a new entrepreneurial wave?
well, I mean, you just have to look at Anthropic. So, Anthropic has new products for AI. Google, for example, makes about $2 million per employee. McKinsey makes about $450,000 per employee. Anthropic makes about $10 to $12 million of revenue per employee. That's at the level of the most elite in Wall Street, like Jane Street, well above the Goldman Sachs's and Morgan Stanley's of this world. And that, I think, speaks to what happens when you have an AI native company. So, typically, the first significant breakthroughs will come from new entrants because incumbents face the innovator's dilemma. They have to struggle with their existing products, their existing channels and customers. But I think we will start to see the returns from incumbents because they have scale immediately. The exception of Anthropic, right? No real startup. Every startup takes 10 years to get to scale, whereas if one of these banks, like Bank of America, Brian Moynihan, the CEO, talked about hundreds of thousands of AI workflows that they were running, their assistant Erica saving something like 10,000 FTE equivalents. I think a business like Bank of America, looking at it from the outside, would be well positioned to adjust a product offering that could only have existed because of AI. But would you expect a CVS or a slow-moving construction business to do that? Probably not as quickly.
Just to sort of focus again on that revenue number, I'm looking for sort of green shoots for like that this will result in a big productivity impact. Is that one way? I don't want to overstate what those numbers mean. Is that one way? Is that since these companies, there's a lot of companies, smart people, they're finding some value. So can I look at those revenue numbers and say, this is a good sign that this is going to be an important general purpose technology, setting aside super intelligence, art, that just as an important new technology that will have a big impact. I can look at those revenue numbers and say, well, that's a sign. That's a sign that it will.
I think, in short, all the things that you'd need to see are starting to be visible. So companies are spending a little bit more. Companies are putting in better budgeting and financial controls on how their employees use the technology. That is a really, really important sign of maturation, because you now have an internal financial model that says, well, if we give these software developers $1,500 worth of AI every month, which is the limit at Uber, we have to get something back. And that suggests that they are getting their sort of teeth into it really realistically. So a lot of people were worried about that the idea that attribution and cost management would come into AI is a bad sign. It's actually a sign of what mature businesses look like. I've launched products out of incumbent companies, sometimes over 100 years old. It's the first 6 months or year where the finance director says to you, just don't really worry about the cost control, just like get it working. And it's year 2 when he comes to you and says, okay, Azeem, now I'm going to hold you to the fire, and you've got to hit your numbers. And we're starting to see that in AI. Now, what I don't know, Jim, and this is I can still see there being a path in all of this where certainly for large parts of sectors like the software sector, this might end up just being an additional cost that they have to pay, right? You're a software vendor, you have to have some AI, so you're having to pay OpenAI or Anthropic something just to stay in the game. It almost becomes like a hygiene tax that you end up paying. I mean, maybe that will happen for some sectors, but for other sectors, I think that the ability to process information in the way and undertake tasks that you might not have been able to previously at low cost has to open opportunities. But I think the thing that we have to understand is that businesses are not about doing tasks. They are about managers coming together to allocate resources against particular objectives with a view to what the risk is. No business was ever about, can we summarize an email quicker than before? And the question is, at what point do AI tools meaningfully come in to make those decisions happen more effectively, either at higher quality, at lower cost, or at higher speed? And that, I think, is the piece that is the difficult part of the transformation that companies will be dealing with over the next year or two.
When we're at the point where I don't have to ask this kind of like that series of questions, when it's sort of obvious, it's obvious that this is a technology being used in all sorts of ways by all sorts of businesses, providing very tangible results. Like, what is the year leading up to that obvious point look like? Is this showing up in annual reports, in earnings calls? Like, what does that world look like where it starts to become very, very obvious, and I don't ask these kinds of questions anymore?
I think one of the earliest points publicly that we could rely on will be in earnings calls, where CEOs and CFOs will start to be much more specific, as Brian Moynihan and his CFO at Bank of America were a few weeks ago, about what they have done, what they have achieved, with specific numbers. And I think the reason that will happen, if that does happen, that will happen on earnings calls, is because about 3/4 of American CEOs think their job depends on getting AI right. So if they're getting AI right, they are really going to want to tell the world in ways that feel somewhat unimpeachable. So we do know that about 30% of earnings transcripts now mention AI, that about a half of those have a quantifiable number attached. Most of that quantifiable value tends to be in a cost saving. And as that mix shifts towards productivity or operating leverage or something else, and we hear it across more and more sectors, that's the moment where you will feel, okay, we're getting towards escape velocity.
Have your thoughts about the impact of AI on job loss or job creation, has that changed at all over the past 3 years? And sort of where are you on that? Because certainly, if the headlines remain screams about job loss. Is that, again, sort of where are you at on that issue, especially as you talk to actual companies?
Uh, I think I may have been bullied by the amount of noise there was out there because I'm a bit of a simple guy. I think of the lump of labor fallacy. I think of complementary roles. I think of the fact that we constantly invent things for people to do. And the data is really mixed, as you know, and Anthropic's chief economist Peter McCrory just summarized a lot of this, saying it's extremely difficult to show job losses, and even in the labor markets with the US so at full employment, coming off the COVID shock, this market is a really confused market for anyone to benchmark. But that said, as you rightly point out, when I do talk to senior execs, there are some who say we're not going to engage in headcount cuts, and there are others, I mean, particularly in the financial services, where it's reasonably clear that that is the case. Now, that's a job loss. Is it necessarily a net job loss? Well, that's going to depend on what else is going on in the labour market. I don't think that we see a cliff edge shock to employment, because there are all sorts of factors that slow us down. One of those factors is just verification and validation, and getting these AI systems to work end to end in companies is really difficult. We also know that politics will play a really significant role. So in China, there was a lower court case a few months ago saying companies can't use AI as a reason to lay people off. Now, of course, things in China don't happen randomly, so there is a little bit of an alignment that is emerging there. And I think what's happened in data centers in the US, which is remarkably the first thing to bring the left and the right together, the first political issue I can remember in a long time, shows that Americans can organize themselves politically to resist a change that they're uncomfortable with. So we've seen it happen with data centers. I'm not going to forecast that this will happen if there is a spectre of widespread job losses, but I would just say that left and right have got together on an issue. And so there are these things that will slow down the way in which companies talk about this, and maybe give managers pause to think. And you've seen this in the change of the narrative from Dario Amodei in the last few months, where he doesn't talk about job losses in quite the way he did a year ago. And I also think that as companies realize that there was so much tacit knowledge in their workforce that they just let walk out the door. I mean, I think back to when Boeing opened their new factory. I think it's in South Carolina, right? So it was, it's across the continent from where all the embedded tacit knowledge of the Boeing engineers who made the 707 and the jumbo jet and so on was. And they started to use many more subcontractors for key roles. And you had really difficult quality issues, because all of that works on a spreadsheet, but it doesn't work in real life. And I think CEOs will start to, unless they feel under a lot of pressure to show savings, want to understand what are we losing when we cut an entire function for an LLM. And all of that, to me, slows down the pace a little bit.
You're talking about the left and the right coming together. One place they've come together is viewing the companies that look like the current winners, particularly OpenAI and the companies going to go public, $1 trillion valuations. We'll see that they view them as the winners, and in order to spread the winnings, they think we should tax them or seize some shares and distribute them. Is the assumption, whether or not you think like that redistribution idea is a good idea, the assumption that we have identified the winners, and it's those companies, have we really identified the winners? Like that, when we look back at the AI revolution a decade, it will be obvious that those are the companies that won and took the spoils, not the not the businesses using the services. Not somebody, I don't know, in the healthcare industry. Maybe that's where the winners are. Do we know
Yeah.
who the winners are?
Well, if you'd asked me 2 years ago, the winner was OpenAI, and Anthropic was really just playing around doing God knows what. So I don't think we necessarily know who the biggest winners are, but there is a point in the development of an industry. You talked about the dot-com cycle, but there was a moment where Yahoo was big enough to be one of the winners. And of course, we think of Yahoo as a business that disappeared, but it did last over 20 years, and it was a titanic force in online advertising. So does Anthropic or OpenAI have a significant role to play in several years' time? I'm absolutely sure that will be the case. I mean, frankly, if they stopped growing, today, they're practically $100 billion revenue businesses. By the end of this year, certainly Anthropic will be approaching that. So that doesn't preclude there being other bigger winners. And the thing that we can start to see is that value really accrues to the infrastructure layer, so where the processing actually happens. And already today, of that $110 billion, I think in June, that 12 months to June 2026, 78% of it was accruing to the companies who run the servers, like Amazon and Microsoft and Google. And that is why you see OpenAI and Anthropic wanting to vertically integrate, because they want to be able to control that margin stack. Now, with all of this open source and open weights innovation that's happened, and you've got this Chinese model called Kimi K3, what does that do?
Yeah, what does that do? And will we ever be able to talk about like powerful American or non-Chinese, at least, open models?
You'll be able to talk about American open models. It will be. It's too important strategically for the nation. The venture capitalists are backing them. There's one I think called Reflection AI, which is doing quite well. You also have Mira Murati has released a small open AI open source model, and it's so economically valuable for the infrastructure providers, the companies who are outlaying hundreds of billions of dollars a year for chips and cooling and memory and data centers, for them to be able to offer top tier open source models, because they get much, much better economics. So there are lots of reasons why the market would want there to be good open source models. And if politics does not allow for Chinese models to take that role, then entrepreneurs will step in and they will develop open source models for the American market.
Do we need to do anything differently to enable the rise of very big, powerful, open models in the United States?
My sense is that there's a little bit of understandable attempts for regulatory capture from the big private companies. They're increasing their lobbying. The messaging for years has been about titanic risks that speak to the purpose of a nation, and I think that's a little bit of a problem. If Demis Hassabis is right, and this is 10 times the Industrial Revolution, which also means it's bigger than steel and the railways coming out in the US and electrification, one of the things that normally happens in history, as you know well, is that all of those social agreements that the state makes with us as individual citizens and economic agents come up for negotiation, whether it is where is the frontier boundary of intellectual property or not. Or, one of my favorite examples is during the build out of the US railroads, another great capital investment splurge, which didn't end as happily, I suspect. The steel companies got together and shared all their patents. It was called the period of Bessemer collective invention. And why did they do that? They did that because in order to take up the opportunity, they just needed to learn from each other really, really quickly. So there is historical precedent for new regimes to emerge. I think it's hard for this administration, given, obviously some of the advisors are split about what looks good, and situations changing very, very quickly. But if we are right that this is 10 times the Industrial Revolution, as Demis Hassabis says, and we can get left and right together around data centers, it does feel like there is space. My concern would be that it's going to be much easier for Congress to think in terms of enclosure than it is in terms of open source and public goods. And so that if there is legislation that comes out, and I haven't kept an eye on it, but I'm just sort of thinking in rough terms about what would be easiest for them to explain. I would suspect it would be in ways that would support closed source proprietary approaches rather than open source approaches. But it may go the other way.
We barely really scratched the surface of that report. We're going to link to it and all that. And it's great. But I did want to ask you something about Europe, about the United Kingdom, about Europe, and the role of places that aren't China and America in the age of AI. What is the economic role of that region? There seems to be there's white papers about innovation, and we create our own models. Where does that stand?
I think there's an incredible opportunity for Europe at the moment, which is you're starting to see hints at. So in France, you have Mistral, which makes open source models. It is growing reasonably fast. It's tiny compared to the American firms, $400-500 million in revenue, but it is a favored choice, particularly of banks who want to use open source, because you've got the French legal system, the EU sitting behind it. It's not coming from China. There's also there are also things that states can do, even if they're smaller states like the UK, because they can clear paths, they can help vertical integration, they can get access to best specific talent. And this is not all about large language models. It's also about models that can simulate physics, or models that can discover new materials. And so that allows you to pick off things that could be quite significant and support them. One thing that happened in the UK is that we got a new prime minister. It's not really news because we have them every few weeks. But he did elevate a minister called Kanishka Narayan to the cabinet, who's the AI minister. And Kanishka has worked in banking, he's worked in venture capital. He is an incredibly clever, capable, driven man who understands the issues as well as anyone, and he sits on the cabinet. So what does that then mean? Well, it's not going to compete with Anthropic or OpenAI, and it certainly won't compete with the Chinese labs backed by the big Chinese tech companies. But there is a space for the robustness of the legal system, for local companies wanting choices that are other than closed source proprietary from the US or Chinese models whose provenance we don't understand. I think one of our biggest problems is that within Europe, the labor markets are incredibly inflexible. And so that raises the cost of hiring for any founder and entrepreneur really, really significantly. And the correlation between the cost to fire somebody and the number of unicorns per capita you generate is a very strong negative correlation. It's roughly, I'm going to say, -1, right? So the worse your labor market is, the less flexibility it has, the fewer great breakout companies you have. But these are all things that can change. They're not laws of physics. It's not like we have to discover the Permian Basin, somewhere between Belgium and Alsace-Lorraine. It is things that people could get together and change. I'm not sure they will, frankly, to be honest, in Europe or in the UK, but the data is increasingly making itself clear.
You mentioned energy. If we had 30 more minutes, we would do 30 minutes of energy. I know that is a specialty of yours, solar. We'll have to wait with that. Azeem, thanks so much for coming on. Just marvelous.
Really enjoy it, Jim. Thanks very much.